Welcome back, best ever listeners, to another episode of Passive Investor Tips. I'm your host, Travis Watts. In today's episode, what we're talking about is underwriting made simple and what you need to know. Disclaimers, as always, never financial advice. Not going to tell you or anyone what to do with your money. So please always seek licensed financial advice when it comes to your own investing. With that top of mind, I want to start with some good news. And the good news is, if you're a limited partner or you're a passive income investor and you're looking to be an LP in syndications, whether it's self-storage or multifamily, you name it, well, it's not really your job to have to know how to underwrite deals, right? That's the job of the general partner or the general partners or the acquisitions and underwriting team, depending on the size of the company. However, this can give you a major upper hand when you're conducting your own due diligence and can help you identify which properties may be better than others and fit your criteria. So in this episode, I'm going to make it as short and simple as possible. I'm going to break down how to underwrite a deal. So let's get started. So let's assume that we're looking to invest in a 400-unit multifamily property in Florida. So how do we determine the value of this property? What would be an appropriate purchase price? Well, what you need to start with is how many units. So in this example, it'd be 400 units. And the next item you need to know are, what are the in-place rents currently? And this can usually be found in the investment overview or slide deck. If it's not, you can always ask the general partners what this number is. And once you have these two numbers, you simply multiply them. 400 times 2,000 in this example equals 800,000 total. Now we can multiply by 12 to get the annualized figure. So if you take 800,000 times it by 12, that's $9.6 million. Now, this would be the case if every single unit was rented all year long and there was no vacancy, which you and I know that's really never going to be the case. So now we need to find the vacancy, and the vacancy is going to differ market by market and property by property. Again, it's usually outlined in the slide deck or investment overview. I'll take kind of a conservative national average right now on apartments, and we'll say it's 93% occupied, which means that they're running at a 7% vacancy. So now that you know that number, you can take the 9.6 million times it by 0.93, and we come up with 8,928,000. Now we need to consider any additional income sources. This is your other income, things like pet deposits, valet trash, maybe Wi-Fi telephone packages where there's a profit split, covered car parking. The list goes on. But I'm just going to throw out an average on there and say that's going to boost this income by maybe 5%. So let's roll with that number. So now we can take that 8,928,000 and times it by 1.05, and we come up with 9,374,400. This, my friends, is your total income that this property produces. Now we need to know what the expense ratio is on this property. Again, it's going to be market dependent and property dependent, but I'm just going to throw an average out there of 40% expenses. So what that means is, as an investor or as a partnership that's owning this multifamily property, you're keeping 60% of that total income and 40% goes towards expenses. So now we can take our total income, which was that 9,374,400. We can times it by 0.60, and we come up with 5,624,640. And this, my friends, is your NOI, which stands for net operating income, which is quite simple. It's your total income minus expenses. This is one of the most important metrics in commercial real estate. And the reason for that is that valuations are primarily driven by the net operating income that a particular property produces. And the last thing that we need to know is the cap rate on this particular deal, which again is usually outlined in the slide deck or the overview. And we can simply take the net operating income and divide by the local cap rate, and that's going to determine what the approximate valuation is for this property. In this specific instance, that would be $112,492,800. And now to get the cost per unit, we can simply take the valuation and divide by how many units are on the property. So in this example, it's 400 units. So we take the 112 million and some change, divide by 400, and you come up with a little more than 281,000 per door. So that, my friends, is really it in a nutshell for simple underwriting from the standpoint of being a limited partner. The number of units, the actual rents in place, times it by 12 to get the annualized number. You got to know the occupancy, the expense ratio, the cap rate, the NOI, and you can run the simple math to determine the value of the property. So why is this important as a limited partner? Well, I believe the fundamentals are always important. This can give you an upper hand advantage as a limited partner when you're going through your due diligence process. But again, it's not your job or obligation to have to know these things, but it can certainly help. So I hope you found some value in this short episode. You're listening to Passive Investor Tips. I'm your host, Travis Watts. Please like, subscribe, share, comment. Reach out if you ever have any questions. I would be happy to answer them. Have a best ever week, everyone, and we'll see you in the next episode.